Today's earnings batch had an aerospace manufacturer actively refusing to build airplane engines at a loss, massive defense contractors moving production to NATO because American factories are completely full, and an $11 billion accounting illusion.
Heavy manufacturing is officially hitting the physical capacity wall.
Right. So we had reports today from RTX, Intel, and Newmont. And if you want to read on the overall character of these reports, the headline numbers are basically just optical illusions completely masking the physical reality of the businesses.
Absolutely. And the biggest story is RTX effectively killing the traditional aerospace business model.
The loss leader.
Exactly. For decades, the model was that engine makers take a massive upfront cash hit on the hardware and they earn it back over 25 years of maintenance contracts. Today, the RTX CEO explicitly rejected that. They are refusing to swallow those heavy margin hits for future aircraft.
Which completely shifts the burden back onto Boeing and Airbus to absorb those upfront costs. But, why draw that line right now?
Because they are physically out of room. RTX admitted their U.S. domestic defense factories are entirely maxed out. They are having to write new co-production frameworks with NATO allies just to process a $289 billion backlog. They literally cannot afford to subsidize new airframe engines when they are that strained on floor space.
You know what is fascinating is that exact same physical constraint showed up in tech today with Intel.
Same story, different sector.
Right. Infinite demand running into a concrete ceiling. Intel had to warn that critical AI server shipments are getting pushed late into Q4, and it is entirely because of a back-end physical packaging bottleneck.
You can have all the AI demand in the world, but if the physical substrate is constrained, the revenue stops. And speaking of revenue, we have to talk about the optical illusion with Intel.
I was hoping we would get to that. The headline prints an $11 billion net loss.
Yes, and if you just read the summary, you would think operations collapsed.
Which is actually, it is just totally false. That drop was a non-operating mark-to-market hit tied to some CHIPS Act escrowed shares. They actually posted their fastest revenue growth in 15 years.
Right. You saw the same dynamic at Newmont. They logged record cash flow today, but an earthquake literally stalled out physical production at their Cadia mine. The cash looks great purely because gold prices spiked. It completely camouflages the friction on the ground.
Prices acting as a parachute.
Exactly. So going forward, I'm watching the backlash from the airframers as RTX forces this new engine pricing model through.
And watch Intel's consumer PC segment. They expect the back half of the year to be sub-seasonal just because components are too expensive to source.
The individual company episodes in the feed hold the actual transcript work showing exactly how these operational bottlenecks are playing out. We'll catch you next time.